Assalamualaikum. Hi everyone. Okay, today I'm going to explain about MFRS 140, that is on investment property. Okay, this is the content for this topic. Okay, first I'm going to touch on the definition of investment property, followed by the recognition, initial measurement, subsequent measurement of investment property. So for subsequent measurement, there are two models that can be applied, that is fair value model and cost model. Okay, and then I'm going to discuss about the transfers or change of use, all right, derecognition as well as disclosure. All right, okay, this is about the learning outcome. Okay, at the end of this topic, okay, you should be able to explain the recognition and measurement of investment property. Second, to estimate and apply professional judgment on the initial recognition, okay, and subsequent measurement of the investment property. And then transfers or change of use of the property, as well as derecognition. And you also should be able to present and disclose the information about investment property in the financial statements. All right, next, let's have a look at the definition of investment property. Okay, investment property refers to the property which is land or building or part of building or both, okay, held to earn rentals or for capital appreciation or both. Okay, so the investment property must refer to a land, okay, or building, okay, or part of building or both, okay, and the land or building must be held in order to earn rental income or for capital appreciation. Okay, what is meant by capital appreciation? Okay, so capital appreciation means the property is held by an entity and by an entity. Okay, the property is held by an entity in order to have the value of property increases over time. Okay, and the land or building should not be used in the production or supply of goods or services or for administrative purpose. Okay, so if the land or building, okay, is used in the production or supply of goods or services or for administrative use, okay, the property should be classified as PPE, okay, instead of investment property. Okay, and the land or building also should not be used or should not be held for sale in the ordinary course of business. Okay, so if the land or building is held for sale in the ordinary course of business, it should be classified as inventory, instead of investment property. Okay, if an entity has a car or a motor vehicle that is used for rental, is it NIP? Can it be considered as NIP? Well, the answer is no. Okay, so a car or motor vehicle is not NIP since it does not meet the definition of IP. Okay, so NIP must be a land or building or part of building or both. Yeah, an investment property must refer to a land or building, right? So therefore, a car is not an IP even though it is used for rental. All right. Next, this is the examples of investment property. Okay, so the examples of investment property include land held for long-term capital appreciation, okay, rather than for short-term sale in the ordinary course of business. Okay, the land that is held for capital appreciation and not for sale, for short-term sale in the ordinary course of business, can be considered as an IP. All right, and then the second one, land held for a currently undetermined future use. Okay, so the land that is held by an entity, that is held by an entity, okay, with uncertain future use, also can be classified as NIP. All right. So if the land is held by a company or an entity with uncertain future use, it can be classified as an IP as well. Okay. And then a building owned by the entity and leased out under one or more operating leases. Okay. So this is also an IP. Okay. So actually, operating lease is quite similar to the concept of rental. Okay. So a building that is held under operating lease shall be classified as an IP as well. Okay. Why is it stated here? Lease out under one or more operating leases. Okay. So why it is stated one or more operating leases? Okay. So actually, an entity can have a building that has many floors or many stories. Okay, and each floor can be leased out separately. Okay, so that's why it is stated that a building owned by the entity and leased out under one or more operating leases, because a building can have more than one floor or one story, and each floor can be leased out separately by the owner or the owner of the building. And then the properties being constructed or developed for future use as investment property. Okay, so this one is also an IP. Okay, since once the building or the property is completed, it will be used as an IP in the future. Okay, so property that is under construction but to be used as an IP in the future can also be classified as an IP. Okay, next, let's have a look at the examples of non-investment property. Okay, so the examples of non-investment property include owner-occupied property. Okay, owner-occupied property. So owner-occupied property includes property held to be used in the future as owner occupied. Okay, or this means, okay, property that is to be used in the future, for example, as an administrative office. And if it is to be used as an administrative office, then we can say that it is owner occupied. Okay, owner occupied property. And then properties occupied by employees of the owner. Okay, this also can be classified as owner occupied property. Okay, so if the property is occupied, okay, by the owner, for example, as an administrative office, or it is occupied by the employees of the owner, okay, the property cannot be classified as an IP. Alright, and then the second one, property currently under construction or development on behalf of third parties. Okay, so this one also cannot be classified as an IP. Okay, because once the property is completed, okay, once it has been fully constructed, okay, it will be sold to the third parties. Alright. And then the third one, okay, properties leased out to another entity under a finance lease arrangement. Okay, so this one is also not an investment property because the property is leased out under a finance lease. Okay, finance lease is like you're selling the property to the third party. Okay, it's not similar to the operating lease. Operating lease is similar to the rental, okay, but finance lease, okay, is like you are selling the property to the third party. All right, and then property held for sale in the ordinary course of business. Of course, this is not an IP, but it is an inventory, right? Next, we go to properties with dual uses. Okay, properties with dual uses. Okay, Okay, let me give you an example of properties with dual uses. Okay, let's say an entity has a building that has 10 floors. Okay, the first 2 floors, okay, are used as administrative office. Okay, while the other 8 floors are rented out to the third parties. So the property actually has dual uses, right? Okay, the first one is for administrative use and second one is for rental. Okay, so the question is, can we classify the building with dual uses as an IP? Can or not? Well, it actually depends on 2 situations. Okay, first, if property can be sold or leased out separately, and second, if property cannot be sold or leased out separately. All right. So for the first situation, if the property can be sold or leased out separately, so that means if each floor of the building or each story of the building can be sold or rented out to the third party separately, okay, the part that is rented out, okay, can be classified as investment property. Okay, for example, just now, okay, we have a building with 10 floors. Okay, so the first 2 floors, okay, are used for administrative office. Okay, while the remaining 8 floors, okay, are used for rental. So the 8 floors, okay, the 8 floors that are used for rental can be classified as NIP. Okay, but the part which is occupied, okay, as administrative office should be classified as PPE under MFRS 116. Right? So if the property can be sold or leased out separately, we can just classify the building separately. Okay, the part which is used for rental, we classify it as investment property, and the portion or the part that is occupied as administrative office, for example, that part should be classified as non-IP or as PPE under MFRS 116. Okay, and for the second situation, okay, if property cannot be sold or leased out separately, okay, so if the property cannot be sold or leased out separately means, okay, each floor of the property, okay, cannot be sold or cannot be rented out separately to the third party. Okay, if the property or the building is to be sold or to be rented out, it must be sold as a whole. Okay, not not separately, not to be sold by floor or by story of the building. So if the building is to be sold or rented out, it must be sold or rented out as one whole building. All right. So in that particular situation, okay, can we classify the whole building as an IP? Okay. So in this situation, we have to look into the significance portion used for owner occupied. Okay, if the portion used for owner occupied is insignificant to the arrangement of the property as a whole, the whole property can be classified as NIP. Okay, let's say just now my example, okay, one building, okay, has 10 stories. Okay, so the first 2 stories are used for owner occupied or for administrative use. Okay, so only 20%, okay, out of the building is used for owner occupied. Yeah, so 20% shall be considered insignificant portion. Okay, usually if it is below 30%, okay, it can be considered as insignificant. Right? So if the owner occupied only 20% out of the total portion of the building, okay, it can be considered as insignificant. Right? The insignificant portion. Therefore, the whole building can be classified as NIP. Alright, but if the portion that is occupied by the owner or the portion that is used for administrative use is significant. Okay, for example, the building which has 10 stories or 10 floors. Okay, half of the building, okay, 50% of the building, for example, is occupied by the owner or used as administrative office. Okay, so part of the building or 50% of the building is occupied by the owner. It is considered significant because the owner occupied half of the property. All right. So if the portion that is occupied by the owner is significant, like 50%. Okay, 50%. Usually more than 30% is considered significant. Right. So if the portion that is occupied by the owner is significant, for example, part or half of the building is used by the owner or occupied by the owner as administrative office, for example, then the whole property should not be classified as NIP but as PPE under MFRS 116. Alright, so if the property cannot be sold or leased out separately, we have to look into whether the portion that is held by that is occupied by owner is significant or not. If it is not significant, okay, say for example below 30% out of the total arrangement of the building, okay, the whole building can be classified as NIP. But if the portion occupied by the owner is significant, say more than 30%, okay, of the whole building, then the whole building cannot be classified as NIP but as PPE under MFRS 116. Alright. Okay, next let's move on to ancillary services. Okay, what is meant by ancillary services? Okay, ancillary services here means support services, okay, such as security and maintenance services, okay, utility services. Alright. So if the entity provide ancillary services to the occupants of a property held by the entity, the classification as investment property is determined by the significance of the services provided. Alright, if those services are a relatively insignificant component of the arrangement as a whole, okay, for instance, security and maintenance services to the lessee, okay, is insignificant, okay, then the entity may treat the property as investment property. Alright. So for ancillary services, okay, such as security and maintenance services, utility services, and so on, okay, if the services provided by the entity, okay, to the occupants of the property is insignificant, okay, is insignificant compared to the whole arrangement of the property, the whole property can be classified as NIP. But if the services provided by the owner of the property to the occupants, okay, are significant compared to the arrangement of the property as a whole, then the property should not be classified as investment property but as PPE under MFRS 116. Okay. So if the services provided to the occupants of a property are significant to the arrangement of the whole property, then the property is not considered as an investment property. For example, when an entity manages a hotel, okay, when an entity or owner of the property operates a hotel, okay, the hotel building cannot be classified as an IP since it provides significant services to the occupants. Okay, so as we all know, there is a number of services that can be provided by a hotel, such as catering services, car rental services, laundry services, okay, spa, fitness gyms, conference room, cafeteria, and so on, which are significant as a whole. Okay, so if the services provided are significant, then the property should not be classified as NIP but as PPE. Alright. Okay, next we go to the recognition criteria. okay, of investment property. Okay, an investment property should be recognized as an asset when it is probable that future economic benefits that are associated with the investment property will flow to the entity, and the cost of the property can be measured reliably. Okay, so if the investment property meets these two criteria, then it shall be recognized as an asset in the statement of financial position. All right. Next, this is about the initial measurement of the investment property. Okay, so an investment property shall be initially measured at cost. Okay, uh, all right. So the cost actually refers to the initial cost of the property. Okay, may include the purchase price, the purchase price of the investment property, and any directly attributable expenditure. Okay, directly attributable expenditure includes professional fee for legal services, property transfer tax, and other transaction costs, right, that are directly related to the acquisition or purchase of the investment property. Okay, so property transfer tax here refers to the tax paid for transfer of ownership of the property. Okay, next, let's move on to the subsequent measurement, okay, of the investment property. Okay, so for subsequent measurement, okay, the entity is allowed to choose one of the following. One of the following models. First one is the fair value model, and the second one is the cost model. Okay, once a model has been chosen, it must be applied to all its investment properties. Okay, and a voluntary change is made only if the change result in financial statement providing reliable and more relevant information about the effects of transaction. Okay, so an entity can change can only can change the model. Okay, for example, from cost model to fair value model. Okay, if the purpose is to provide more reliable and relevant information to the users of financial statements. Okay. All right, next we go to the first model, that is cost model. Okay, this is actually similar to the one that we apply for PPE. Okay, so under the cost model, property is measured in accordance with MFRS 116. It's similar to the application of model for PPE. All right, so the property is measured at cost less accumulated depreciation and accumulated impairment losses. All right, so this is for the cost model. Okay, and the second one is the fair value model. Okay, so fair value model, the property is measured at fair value or market value. Okay, what is meant by fair value here? Okay, fair value refers to the amount for which an asset could be exchanged between knowledgeable willing parties in an arm's length transaction and should reflect market conditions at the balance sheet date. Okay, so fair value refers to the amount of for which an asset could be exchanged between knowledgeable parties. Okay, so the parties here refer to the seller and buyer. Okay, the seller and buyer must be knowledgeable. Okay, with regards to the related transaction, with regards to the transaction. Okay, and both parties, seller and buyer, must be willing to sell and buy. Okay, at the agreed amount of at the agreed value of asset. All right, and in an arm's length transaction. Okay, it must be in an arm's length transaction, and should reflect market condition. It should reflect the market condition or market value of the property at the balance sheet date. Okay, what is meant by arm's length transaction here? Okay, arm's length transaction is a transaction between unrelated parties acting independently with no special relationship. Okay, so the parties involved in the transaction, seller and buyer, they must be independent from each other. Okay, say for example, if a mother sells a house to her daughter or her son, okay, so that is not considered as an arm's length transaction. Why? Because the transactions involve two related parties, mother and son or mother and daughter. So they are not independent from each other. So this transaction is not an arm length transaction. So arm's length transaction must involve two parties, okay, seller and buyer, that are independent or unrelated from each other. Okay, and then any gain or loss arising from a change in fair value is recognized in SOPOL for the period in which it arises. Any gains or loss, okay, shall be recognized in the SOPOL, all right, for the period in which it arises. All right, so next, let's have a look at the example. Okay. Yumi Berhad is involved in the manufacturing of biscuits and confectionaries. On 1st January 2012, the company acquired a building in Pulau Langkawi at price of 7 million. Legal and transfer fees of 500,000 and 20,000 were incurred respectively. Okay, this is actually the initial cost. The costs involved here, okay, can be included as the initial cost of the property, right? Is the purchase price, okay, the legal and transfer fees, okay, these are the initial cost of the investment property. And then the estimated useful life of the building is 50 years. Okay, the building was rented out immediately to Trax Berhad for 388,000 per month. Okay, so the building was rented out. So that means the building meets the definition of NIP. Okay, it can be classified as NIP. Okay, and the tenant or the lessee, Trax Berhad, use the building as a hotel. Okay, so in this situation, it's not the owner who uses the building as a hotel. Is the tenant, the tenant or the lessee who actually uses the building as a hotel. Okay, so that means the owner does not directly involved in the hotel business. Okay, it is the tenant who is involved in the hotel business. Okay, so to the owner, to the Yumi Berhad, the hotel is considered as NIP. Is still considered as NIP because the owner is not directly involved in operating the hotel. The owner rents out the hotel to the third party, and the third party is the one who operates a hotel. All right. And then the fair value of the building on 31st December 2012 and 31st December 2013 were 7,990,000 and 7,828,000 respectively. Okay. Yumi Berhad adopts the fair value model for the subsequent measurement of its investment property. Okay, the question is, discuss the accounting treatment of the building for year ended 31st December 2012 and 2013. Okay, so let's have a look at the answer. Okay, so this is actually the example for fair value model. All right, so the answer for this question, okay, the building is classified as investment property on 1st January 2012 at the initial cost of 7,520,000. That is 7 million, the purchase price, plus 500,000 plus 20,000. Okay, these are the initial costs of the investment property. Okay, so the building can be classified as investment property because it is used for rental. All right. Since Yumi Berhad has adopted the fair value model for its investment property, changes in the fair value will be recognized in the statement of profit or loss. Okay, the change in fair value. That means the increase or decrease in the fair value, okay, will be recognized in the SOPOL. Okay, an increase in the fair value of 470,000, that is, okay, 7,990,000 minus the initial cost. The initial cost 7,520,000 on 31st December 2012 shall be credited to the SOPOL. Okay, so the increase in the fair value of 470,000, the increase in fair value of 470,000 shall be credited to the SOPOL, or in other words, it shall be recognized as fair value gain, okay, in the SOPOL. Okay, while a decrease in the fair value of 162,000, okay, 162,000, that is 7,828,000 minus 7,990,000, okay, on 31st December 2013 shall be written off in the SOPOL. Okay, so the decrease in the fair value, okay, should be recognized as a fair value loss, okay, in the SOPOL. All right, it should be written off in the SOPOL, or it should be recognized as a fair value loss in the SOPOL for the year ended 31st December 2013. All right, and the building shall not be depreciated. Okay, so if the entity applies the fair value model, okay, the depreciation should be ignored. Okay, the depreciation should be ignored. All right. Next, okay, let's have a look at the journal entries for the transaction. Okay, so on 1st January 2012, we should record, okay, the initial cost of the investment property or the initial measurement of the investment property. So we debit the investment property 7,520,000, okay, at its initial cost, and credit cash or payable with the same amount. And on 31st December 2012, we know that there is an increase in fair value, okay, amounted to 470,000. So we should debit the investment property because we have to increase, okay, the value of the investment property, and we have to increase so that the carrying amount should be at its fair value. So we have to debit 470,000 and credit SOPOL fair value gain 470,000. All right, and on 31st December 2013, okay, so we know that there is a fair value loss since there was a decrease in fair value. Okay, there was a decrease in fair value loss, so we have to recognize a fair value loss in the SOPOL. What do? Is we have to debit SOPOL fair value loss 162,000 and credit investment property 162,000. Why do we have to credit investment property? Because we have to reduce, okay, the value of the investment property to reflect its fair value on 31st December 2013. All right. Okay, so that's all for the first part of my lecture on investment property. Thank you very much for watching.